Good afternoon, everyone, and good morning to those of you joining us on the West Coast today. Segal Select Insurance would like to welcome you to today's webinar presentation. This is our core insurance policies and introduction. Now I'll introduce our speakers. First, we have Russell Bly, our senior broker, and Brian Smith, our chief operating officer. Now I'll turn the call over to Brian.
Thank you, Liza, and welcome, everyone. This is the session that in many respects is the most fun for us to do because it's an introduction. It's meant to review certain basic elements of the different type of policies that we are getting ourselves involved in. And this time we decided to try and cover all four of our core products, which you'll see on the screen: fiduciary liability, fidelity bonds, cyber liability, and employment practices liability. We perform these products over two industry segments: the multi-employer or Taft-Hartley industry segment and our public sector segment. And we realized there may be many folks from both segments in this call, so we are going to try and make sure we pay attention to unique characteristics that may exist within each area. But looking at our core products, which I just said were the fiduciary, the fidelity, cyber liability, and employment practices, we'd like to start immediately with our first question and find out how many of you are buying which groups of these products. So there's four selections here. If you take a look at them, please answer the one that is the most applicable to you. We're assuming everyone will at least have the fiduciary and the fidelity, so that is our default if you don't have three or four of them. So we'll wait a second and see what these responses look like. All right, let's move forward. I think we want to keep looking at these things, so let's shut it down. About 40% are saying they buy fiduciary and fidelity. 30% are saying fiduciary, fidelity, and employment practices. 10% are saying fiduciary, fidelity, and cyber liability, and 20% are saying all four. So quite a different spread here. Not probably what, Russell, what we might have anticipated on this.
No, definitely not.
I honestly would have thought the fiduciary and the fidelity would have been higher. So maybe this is a good sign. But let's move on and let's look at fiduciary to start with. We're going to give you the takeaways first. We'll give you some of the highlights and then we'll go down into some of the specifics. And since we're going to be covering so much material within this hour, we're going to leave a lot of it at the very high level. Applicable to both industry segments, we're going to say trustees are personally liable. Under the Taft-Hartley multi-employer ERISA, we know that categorically is correct. For most of our public sector plans in any state statutory law we've seen, we still see personal liability being imposed. And I think I'd be fairly comfortable in saying that that's going to be true throughout the country for all of our public sector clients. Scope of coverage under these policies is expanding. And Russell, this past year particularly, we've seen some really major expansions in the scope of coverage, haven't we?
We certainly have. A number of carriers have offered enhancements to their policies. Everybody doing a slightly different approach, but sure, certain enhancements are coming along.
And we're going to talk about that slightly different approach in another slide because that's a very important observation. These policies are designed to protect your personal assets, and this, we believe, is really critically important. And for your public sector trustees, we think this is one of the real benefits of a fiduciary liability policy. While your sovereign immunity and agency indemnification offers very, very strong protection, they are limited in their scope. And the fiduciary policy can go beyond the scope of where those indemnities may offer you protection. And that can be invaluable if it ever becomes necessary to tap into it.